Let's be honest, when you think of the hotel industry, one name probably pops in your head first: Marriott. They're not just a big company, they are, without a doubt, the top dog, the largest hotel company on the entire planet. So let's dive in and really unpack what that means if you're looking at it as an investment. I mean, to really wrap your head around the sheer size of this operation, just look at this number: 1.74 million. That's how many rooms Marriott has under its umbrella. We're talking about nearly 9,600 properties scattered across more than 140 countries. This isn't just a chain, it's a global empire.
And that brings us right to the heart of the matter, doesn't it? That incredible travel boom we saw after the pandemic, well, it's starting to cool off. The economy's showing some cracks. So for an investor right now, is Marriott's massive size a safe harbor in a storm? Or is it just a giant ship that's going to be really, really hard to turn?
Okay, let's start with the good stuff, the bull case. This is the argument for why Marriott is an absolutely fantastic investment. And really, the best way to picture it is as a business fortress with some seriously high, well-guarded walls. Now, the secret to Marriott's kingdom, the foundation of this whole fortress, is its asset-light model. And here's the genius of it. They don't actually own most of these hotels. Nope. They let other people deal with the mortgages, the property taxes, the leaky roofs, all that expensive stuff. Instead, Marriott just provides the brand and the management system, and in return, they collect these super stable, high-margin fees. It's a brilliant way to expand their empire without taking on all the risk. So what does this actually mean for you, the person holding the stock? Well, first off, your money isn't tied up in billions of dollars of risky real estate. It means the company is a cash machine, pulling in predictable fee revenue year after year, and that translates into absolutely massive amounts of free cash flow. And what do they do with all that cash? They hand it right back to you. We're talking billions returned directly to shareholders through stock buybacks, over $4.5 billion in 2023 alone. And that brilliant asset-light model fuels this incredible self-reinforcing loop. It's like a flywheel. Think about it. Their huge scale attracts travelers from everywhere. Then, their powerhouse loyalty program Bonvoy gets its hooks in them. Those loyal members then book their rooms directly on Marriott's website, which is way more profitable for the hotel owners than paying a commission to some online travel agent. And because the owners make more money, guess what? More hotel owners want to slap a Marriott brand on their building, which just makes the whole system bigger and stronger, and the cycle starts all over again. And this is the engine that drives that entire fortress. Almost 248 million people. That's how many members are in the Marriott Bonvoy program. This is not just some mailing list. It is one of the most powerful direct-to-consumer platforms in the world, period. In fact, these members account for a mind-boggling 69% of all the occupied rooms in the system. So, what's the bottom line here? A competitor can't just build a couple of nice hotels and expect to take on Marriott. No way. They would have to replicate this entire global ecosystem, the brands, the millions of loyal members, the trust with hotel owners. That right there is what you call a formidable barrier to entry. Okay, that's a pretty convincing case for the fortress, right? But even the strongest fortress isn't totally immune to what's happening outside its walls. So now, let's flip the coin and look at the bear case, the headwinds that are starting to brew. The first major red flag is that growth is hitting the brakes hard. The key number we watch in the hotel biz is RevPAR. That's just revenue per available room. After jumping almost 15% in 2023, coming out of the pandemic, look at how fast that growth is slowing down. The forecast for the middle of 2025, a meager 1.5%. That is a dramatic deceleration, and it's a warning sign for the whole industry. And it's really no mystery why this is happening. Let's face it, travel is something you do with extra money, and it's super sensitive to the economy. With inflation being sticky, economic growth slowing way down, and higher interest rates making everything more expensive, well, people and companies are starting to watch their wallets. And at the exact same time, the cost to actually run a hotel, things like wages and insurance, is going through the roof. So profits are getting squeezed from both sides. And then there's this other massive wild card, the future of work. On one hand, there's a real risk that traditional corporate travel, the fly in for a meeting and fly out kind, might never come back to what it was. That was the bread and butter. But there's another side to this coin. This rise of bleisure, people blending business and leisure, maybe adding a few vacation days onto a work trip, that's creating a new type of traveler who stays longer. The billion-dollar question is whether this new trend can really make up for the potential loss of the old one. So we have this fortress of a business, but it's facing some very real storm clouds on the horizon. And that brings us to the final and maybe the most important piece of the puzzle for any investor, the price. What do you have to pay for this thing?
So, what's the market's price tag on this industry champion? Is it acknowledging all these risks we just talked about? Or is the stock priced for absolute perfection? A good way to measure this is by looking at a metric called EV to EBITDA. Just think of it as the price of the whole company relative to the cash it's earning. At over 20 times, you can see Marriott is trading at a pretty hefty premium compared to its peer IHG. Sure, it's not quite as pricey as Hilton, but the message from the market is loud and clear. We know you're a high-quality company, and we're going to make you pay up for it. And that, right there, is the catch. When you pay a premium price for a stock, you are betting that things will continue to go really, really well. There is just less room for error. If that slowing growth we talked about suddenly turns negative, or if those economic headwinds get even stronger, a stock that's priced this high has a lot further to fall.
All right, we've laid out the powerful case for buying Marriott and the pretty worrying case against it. So let's try to put it all together. What's the final verdict for someone looking to invest in Marriott today? It really all boils down to this one fundamental trade-off. On one side, the bulls will tell you you're buying a best-in-class fortress, it's got the scale, the loyalty program, and it's a cash-gushing machine. But on the other side, the bears will say, yeah, but you're paying a premium price for a company whose fate is tied to the economy, right as the economy is starting to look shaky. And honestly, both sides have a really good point.
So the final question really is for you to answer. Is Marriott's incredible quality, its fortress-like business, enough to justify paying that premium price, even with a storm brewing? Or is it simply too expensive for a great company that's sailing straight into some very strong economic headwinds? The answer to that is probably going to determine whether this is a great investment from here.